when demonstrating these problems, I will be using our accounting equation. This is the expanded accounting equation. The basic accounting equation is just assets equals liabilities plus owner's equity. And in sole proprietorship, the owner's equity account is called capital. And notice we have our plus sign for assets on the left side, the debit side, and the plus sign for liabilities is on the opposite side of assets, since it is on the opposite side of the equal sign. So the plus for the liabilities and capital is on the right side, the credit side. And then for capital, there's two things that make capital go up: revenue, which is when we sell something, and investments. I've placed these under the positive side of capital because they both make capital go up. And then there are two events that make capital go down, so we've placed them on the minus side. They are expenses and withdrawals. Notice the expenses have the plus sign, the opposite of revenue. Same withdrawals. So let's start working on this problem. In March 31st, we have recorded cash sales of $170,000. We're going to collect a 5% sales tax for the state of New Jersey, and then later in April, we're going to pay the sales tax. So let's do the March 31st entry first. We're going to record cash sales of $170,000 plus we're going to collect that 5% sales tax. So we know our cash is going to be increasing, therefore the cash, which is an asset account, is going to be the debit. And as always, we have to list the debits before the credits. We also have to record our sales revenue. And the amount of sales revenue that we're going to record is we sold $170,000 worth of items. Sales revenue, we know we have more sales revenue since we've made a sale, obviously. So the revenue is increasing. That's why the sales revenue is going to be a credit. We also know we have to record a sales tax payable. And this sales tax payable is increasing our liability. Once our customers pay us that money, we now owe that to the state. So this liability is increasing. That's why I'm going to be putting it on the credit side. And the amount of sales tax that we have to collect is going to be 5% of $170,000. That turns out to be $8,500. The cash amount that we collect is the combination of the sales revenue and the sales tax payable, $178,500. We record our comment to record cash sales and the related sales tax. Then later in April, we have to send our March sales tax to the state. So this liability, which was increased on the right side, is now going to be decreased because as we pay that sales tax payable, a liability, we have to get rid of it. It's being lowered. And cash, which is an asset, is being lowered, so therefore it is the credit account. And our comment's going to be record cash payments for sales tax payable. A more realistic comment for paying the sales tax would need to include the check number.